Most people think corporate losses are obvious. Revenue falls, profits disappear, and the stock price reacts. But in reality, some of the largest corporate losses never look like losses at all. They're buried in accounting adjustments that are legal, common, and often ignored by casual investors. One of the most widely used techniques is labeling losses as one-time or non-recurring. In theory, these charges should happen once. In practice, many companies use them repeatedly. Take IBM, for example. For years, IBM reported restructuring charges almost annually while simultaneously highlighting adjusted earnings that excluded those costs. The message to investors was that performance was stable, even though the core business was under pressure. Another major example comes from Meta, formerly Facebook. Meta frequently reports adjusted earnings that exclude stock-based compensation. In 2023 alone, Meta issued tens of billions of dollars in stock to employees. While this is labeled a non-cash expense, it dilutes shareholders over time. The company can appear highly profitable on an adjusted basis while quietly transferring value through equity compensation. Stock-based compensation is one of the most powerful loss-hiding tools in tech. Amazon has long relied on it. For years, Amazon's GAAP profits were thin or inconsistent, but adjusted numbers looked far stronger because large stock grants were excluded. The business wasn't losing cash, but shareholders were paying the cost through dilution. Another common tactic is asset write-downs. When companies overpay for acquisitions, they don't immediately admit the mistake. Instead, they write down the asset years later. AT&T is a textbook case. After acquiring DirecTV and Time Warner at high valuations, AT&T eventually recorded massive write-downs totaling tens of billions of dollars. These losses were labeled non-cash impairments, but the cash had already left the business long before. General Electric offers another powerful example. GE repeatedly used restructuring charges and asset impairments to reset expectations. Each time, management framed the losses as part of a turnaround, allowing future earnings to look cleaner. Over time, however, investors realized the one-time charges were anything but one-time. Then there's the use of adjusted earnings to manage Wall Street expectations. Tesla, for instance, often emphasizes non-GAAP profitability that excludes stock compensation and certain operational costs. While Tesla generates real cash flow, the gap between GAAP and adjusted numbers can significantly change how profitable the company appears in headlines. Restructuring charges are also common in retail and manufacturing. Intel and Boeing have both used restructuring and special charges during difficult periods. Boeing's accounting during the 737 MAX crisis included deferred production costs and special charges that allowed losses to be spread over time, reducing their immediate impact on reported earnings. Perhaps the most important metric companies can't easily hide is free cash flow. WeWork famously reported adjusted metrics like community-adjusted EBITDA, which excluded rent, its largest expense. While earnings presentations looked optimistic, cash flow told a very different story. The business ultimately collapsed because the economics never worked. None of these practices are illegal. In fact, they are disclosed, usually deep in earnings reports and footnotes. The real issue is emphasis. Headlines focus on adjusted earnings, while the true cost of doing business is quietly excluded. The lesson for investors is simple. If a company keeps reporting strong adjusted profits but weak cash flow, repeated one-time charges, or rising dilution, the losses may already be there, just hidden by accounting. If this breakdown helped you see corporate numbers more clearly, follow Real Business Today for daily breakdowns of business, finance, and how money actually moves behind the scenes.